Welcome. You're here because you want to know, have we finally found the best investment fund? Is it even possible to find a fund that consistently beats the market, especially one as tough as the S&P 500? Well, stick around because by the end of this video, I'm going to reveal a fund that has outperformed for the last decade. And trust me, the winner might surprise you. We've uncovered some unexpected twists and turns on our journey to find the champion. Oh, and by the way, I'm also going to share some key tips that could save you thousands or even millions in the long run. Seriously, you don't want to miss these. Before we dive in, make sure you hit that subscribe button. Why? Because subscribing not only supports the channel, but ensures you don't miss out on future content that could drastically improve your investment strategy. Let's get started. Let's start by zooming out and looking at the sheer scale of the investment world. It's easy to get lost in the vast number of options. We've compiled an extensive database of 10,225 funds specifically for this video. These funds collectively manage nearly $63 trillion in assets. Let that sink in for a second. $63 trillion. To put that into perspective, that's almost 3 times the size of the entire US economy. It's absolutely staggering. These funds cover everything you can imagine: stocks, bonds, real estate, commodities. Whatever sector you're interested in, there's a fund for it. But with so many choices, how do you find the best one? How do you know which fund will deliver the best return for your hard-earned money? Well, let's face it. Most of these funds don't beat the market. In fact, many of them underperform. So, how do we separate the winners from the losers? Stick with me, because we've built this database to do exactly that. Today, I'll show you how we've sifted through the data to uncover the ultimate fund champion. Here's one of the biggest traps investors fall into: lifetime average returns. You might see a fund claiming, "We've returned 15% per year since the 1970s, and think, "That's incredible." But here's the catch. What if that fund's stellar performance happened decades ago, and it's been underperforming ever since? Let's take the legendary investor Warren Buffett as an example. Now, don't get me wrong, Buffett is brilliant. His Berkshire Hathaway fund has crushed the S&P 500 since its inception. But over the last 10 years, not so much. His traditional focus on industrials and energy hasn't kept up with the booming tech sector. This is exactly why we can't rely solely on lifetime averages. What happened 30 or 40 years ago doesn't matter much when it comes to today's market. And the market today is very different from what it was even 20 years ago. So, the lesson here is simple. When looking at a fund, don't just focus on its lifetime return. You need to dig deeper and look at recent performance. Why focus on recent performance? Because markets evolve. Entire industries that were dominant decades ago are no longer the leaders. Think about it. 20 years ago, oil and steel companies were the titans. Today, it's all about technology. You've seen it. Companies like Apple, Amazon, Tesla, they've completely reshaped the investment landscape. Meanwhile, exchange-traded funds and index funds have skyrocketed in popularity, challenging traditional mutual funds. That's why we've narrowed our focus to the last 12 years. Now, you might be asking, why 12 years? Let me explain. Most investment experts agree that a 10 to 15-year period is the sweet spot for evaluating a fund's performance. It's long enough to capture market ups and downs, but not so long that we get stuck in past market conditions that don't apply today. Take John Bogle, the founder of Vanguard. He emphasized the importance of analyzing funds over a longer time frame, specifically 10 to 15 years. That way, you see how a fund performs not only in bull markets, but also during downturns. So why 12 years? It's the perfect compromise between 10 and 15 years, long enough to see if a fund can handle both good times and bad, but short enough that we're not stuck in the past. And it also includes a wide range of market conditions, from the post-2008 recovery to the COVID crash of 2020. By looking at this 12-year period, we can identify the true champions, funds that perform through thick and thin. Before we dive deeper, I want to hear from you. What do you think? Is there a fund you believe has consistently beaten the market over the last decade? Drop a comment below and let me know. Let's take a trip back in time to see how far investment funds have come. Did you know that in 1924, there was only one investment fund in the US? Just one, the Massachusetts Investors Trust. Fast forward to today, and there are over 10,000 active funds. But here's something fascinating. Of all the funds in existence today, only 61 were around back in 1971. Think about that. Just 61 funds have stood the test of time. But here's the catch. Longevity doesn't necessarily mean performance. Just because a fund has been around for decades doesn't mean it's still a top performer. The truth is, many long-standing funds aren't outperforming the market today. What really matters is consistency, especially over recent years. Now let's dive into our strategy. I wanted to find the fund champion, the one fund that consistently beats the S&P 500, no matter when you invest. To do that, I developed a plan. We started by looking at how many funds beat the S&P 500 last year. From there, we worked our way backward, asking, how many of these funds also beat the index over 2 years? Then, how many beat it over 3 years? And we kept going, eliminating funds that failed to outperform each step of the way. In theory, I thought that after 20 years, we'd be left with just 1 or 2 funds, the ultimate champions. But the results were surprising. Here's what we found. In 2023, 1990 funds outperformed. After 2 years, that number dropped to 768. After 3 years, it was down to 585. And after 12 years, the focus of our analysis, there were still 283 funds standing. Now, I have to clarify something important. These funds didn't necessarily outperform every single year, but the cumulative performance of these funds was better than the S&P 500, regardless of when you started investing. Let's go even further back. As we continued our analysis, we went back to 1974 and found that 11 funds have met our criteria over the last 50 years. To give you an idea of how much your money would have grown, here's what a $1,000 investment in 1974 would look like today. Fidelity Advisor, Diversified Stock Fund. Your $1,000 would now be worth over $504,000. The Nicholas Fund, you'd have $408,000 today. Mayors and Power Growth, that $1,000 would be worth $357,000. It's staggering to see how much these funds have grown over time.
Wow.
But it's important to note that just because these funds have performed well over 50 years, doesn't mean they're still champions today. You might be wondering, how do we actually measure which funds are the best? That's where the Treynor ratio comes in, and I promise it's easier to understand than it sounds. Think of it like this. It's not just about how much money a fund makes. It's about how much money the fund makes in relation to the amount of risk it takes on. So, the Treynor ratio tells us how much return a fund delivers for each unit of risk it assumes. Imagine 2 funds that both made you 10% last year. But if one of those funds took on huge risks to get there, while the other managed the same return with much less risk, the second fund is the smarter investment. That's what the Treynor ratio helps us figure out. It shows us which funds are better at balancing returns and risk. So, here's what we did. We took the 283 funds we identified earlier, the ones that have outperformed the S&P 500 over the last 12 years, and we calculated their Treynor ratios. The goal is to find the one that not only made the most money, but did so with the best risk management. Now, the moment you've all been waiting for. After carefully analyzing the last 12 years, the fund that consistently outperformed the market, particularly the S&P 500, while managing risk effectively is CIBC NASDAQ Index Premium. Surprising, right? It's not even an actively managed fund, it's an index fund. That's right, even though we typically think of actively managed funds as the ones that might outperform, this index fund has consistently beaten the S&P 500 over the last decade. So, why is this so impressive? because an index fund isn't trying to pick individual winners or time the market. It simply mirrors the NASDAQ index, which has been driven by tech giants like Apple, Microsoft, and Google. Yet, with a nice Treynor ratio, this fund has managed to deliver strong returns while keeping risk in check. To give you an idea, if you had invested $1,000 in the CIBC NASDAQ Index Premium Fund in 2012, that investment would have grown to $10,250 by the end of 2023. By comparison, the same $1,000 invested in the S&P 500 during the same period would only have grown to $3,793. So there you have it. The CIBC NASDAQ Index Premium is our ultimate champion fund. It's a reminder that sometimes the simplest approach, like an index fund, can outperform even the best active managers. But remember, past performance is no guarantee of future success, so it's important to stay informed and keep a long-term perspective. After analyzing decades of data and thousands of funds, we've identified the ones that consistently beat the S&P 500 while managing risk. If you learned something new today, hit that like button and don't forget to subscribe for more investment insights. I'd love to hear from you. What's your favorite fund and why? Drop a comment below and let's keep the conversation going. Thanks for watching, and I'll see you in the next video.